concrete structures need cement. Good afternoon, distinguished pronoun audience. We came in representation of Tecnológico de Monterrey Campus Querétaro to present our initiation of coverage about CEMEX SAB-DCB. We're Denise, Camilo, Alejandro, Carlos, and your server Jessica. We issue a buy recommendation with a target price of $10.16 US, adjusting the resource to the last reported quarter, resulting in a 26.19% upside compared to its closing price of $8.05 US as February the 2nd of 2018. CEMEX and its subsidiaries produce, market, distribute, and sell cement, ready-mix concrete, aggregates, and other construction materials in more than 50 countries around the world. Their board of members have at least 15 years working for the company and have constantly adapted to the firm's situation. In 2016, the firm invested $80 million US in sustainability projects. Our buy recommendation was mainly driven by a solid business strategy, a strong competitive positioning, leadership in market trends, and a constantly improved financial performance. With over 100 years of experience, nowadays CEMEX's strategy has focused on creating value through the construction and management of a global portfolio. This has led the company to become the third largest cement producer in the world. Having a well-diversified location, its main markets are the United States and Mexico. Their portfolio is composed of three core products: cement, representing 45% of its net sales, concrete, 39%, and aggregate, 16%. CEMEX also counts with related construction services, offering internal construction solutions for its clients. Their strategy is based in four main pillars: valuing their employees as their main competitive advantage, moving towards a more customer-centric service, seeking for long-term profitability markets, and ensuring the integration of sustainability in the business.
Global growth is reinforcing, contributing to an improvement in economic confidence, projected to accelerate 2.9% between 2018 and 2019. Specifically, for relevant markets, Mexico's, USA's, and Europe's GDP are expected to rise by 4.4%, 2%, and 1.6% respectively for the end of 2018. CEMEX operates in the construction materials industry, which behaves as an oligopoly due to the high needs of capital investment, the difficulty to extract raw materials, and the high prices for energy and transportation. Among the industry drivers are the population and urbanization growth, construction indexes, price indexes, energy prices, and housing starts. The main industry trends include a shift to alternative energies, the development of sustainable products, and adherence to ethical industry standards. To compare against the three industry competitors, LafargeHolcim, HeidelbergCement, and CRH, CEMEX has addressed global trends and seeks to achieve market penetration by relying on a wide distribution-centered network, offering value before volume to its clients, and using a vertical supply chain integration as a competitive advantage. In fact, the company just supplies 50% of its total raw materials from another suppliers. The key factors through which competitors can be assessed are installed capacity, research and developer investment, alternative energy uses, global expansion and distribution network extension. The optimal combination of those variables are reflected in the operating cost efficiency, in which CEMEX leads with a 13.1%, followed by HeidelbergCement with a 10.8%, and finally by LafargeHolcim with a 10.5%. We could see that despite the limitations imposed by the agreement, CEMEX has been able to continue with its strong position in the market.
Over the last 5 years, CEMEX strategies have allowed their net sales 5-year annually compounded growth rate to jump from -3.3% to 5.6% in functional currency. In line with the sales growth recovery, the company has been able to effectively apply their debt reduction and higher efficiency resulting strategies, reducing mainly their COGS and their interest expenses over the last 5 years, allowing the company to achieve a net income margin of 7.1%. Liquidity is clearly an issue that the company faces nowadays, since the current assets represent 64% of the current liabilities. Nevertheless, the company has a negative cash conversion cycle and a short-term debt coverage of 1.26 times. Reduction of financial the company to reach a credit rating of BB. Their consolidated leverage ratio went from 7.4 times to around 4 times in the past 7 years, while their debt-to-capital ratio went from 56% to 52% in the same time frame, meaning that the company has been historically the most leveraged firm in the whole industry. In terms of profitability, CEMEX achieved a ROI of 10.9%, the maximum among its peers. This was mainly driven by a higher than the industry's net income margin and asset usage efficiency just below the industry's median and the highest equity multiplier. However, in terms of ROA, the company was located just above the industry's median, which suggests that the main driver of the ROA has been the financial leverage. Lastly, both the ROA and the ROA have been constantly improving due to the enhancement of the net income margin.
Our target price of $10.16 per ADS was composed with a weighted average of 70% from the DCF valuation, ending with a value of $10.53 and 30% from the relative valuation, resulting on a price of $9.30. The main inputs of our DCF valuation were a sales forecast based on building construction, non-residential building, civil engineering, and industrial production indexes projections from the main countries where CEMEX operates, considering a time frame between 2018 to 2022. Capital expenditures were determined as a portion of total net sales per year projected, considering the last 5 years as an average. For the terminal growth, we used a 10-year US Treasury bond projected for 2022. As a discount rate, we used a WACC composed by a cost of debt, which considered the interest rate disclosed by the company, and a cost of capital determined with the CAPM. For the CAPM, the 10-year US Treasury bond was considered as a risk-free rate. As an equity risk premium, a variable retrieved from an study survey done by the IESC Business School, and finally, the beta was calculated as an average of two methods. The first one consists on a 52 two-year weekly moving betas, and the second one on a proposal based by Asbata Modaran, professor from NYU. The WACC varied from 2018 to 19, considering the changes in capital structure, considering of achieving an investment rate grade by 2019 and then remain constant. As a relative valuation, we consider an EV/EBITDA multiple and comparable companies in terms of financing structure, size, growth, and business as the ones from CEMEX. The EV/EBITDA multiple was used as it is considered to give an overview of the company at an operative level, leaving aside issues that arise from capital structure and taxation.
We run a Monte Carlo simulation with 1 million iterations, modeling our 4 variables: sales, capex, WACC, and terminal growth rate. We obtain a mean of 10.80 USD per ADS and a buy probability of 69%. We did a risk analysis resuming this matrix, which shows the probability and the impact of the different risks that we identified. We select 3 of them as the most important ones. An appreciation in the US dollar could reduce the capacity to meet the financial obligations, considering that 62% of CEMEX total debt is denominated in US dollars and just 25% of the total sales comes from the US. Even when CEMEX has a sole limited use of derivatives due to a credit agreement, they started a plan in 2017 to use forwards in the USD Mexican peso, hedging around 40% of the total sales in Mexico. Another risk is derived from an increase in energy prices, considering that 25% of CEMEX COGS comes from the use of energy, and it's forecasted an increase of 17% in the oil price for 2020. To mitigate this, 23% of the fuel that CEMEX uses comes from renewable resources, and it's expected to increase up to 35% in 2020. The last one is an increase in interest rate in the US, as 20% of CEMEX total debt is denominated in US dollars at a variable rate. Consequently, CEMEX debt will increase, and if they want to refinance, it will be in worse terms. For that reason, 69% of CEMEX total debt is at a fixed rate. They hedge using interest rate swaps, and they are trying to achieve a credit rating of BBB-.
To sum up, we reaffirm our buy recommendation, as we believe that CEMEX's solid business strategy, strong competitive positioning, leadership in market trends, and constantly improved financial performance will enable this growth. Thank you, and the floor is open for questions.
I'll do it without time constraints. So excellent work, thank you very much. My main question would be, what do you think, based on your analysis and valuation, would be the largest risk, not necessarily to the company, but to your valuation, to say, oh, we were wrong, this was not a buy, this actually is.
Okay, we have three main risks. We have three main risks. The first one is the cost, and the second one is the is here. As we can see, the growth rate and the WACC 2018, they are the variables that affect the most our valuation. If 1% of in the movement in the growth rate and in the WACC of 2018 affects in $2 our valuation, just a 1%. And but these variables are affected because they are taken into account like perpetuity. So if we take outside these variables, the one that most affect our valuation is the COGS. So the COGS, one movement of COGS means a 1.50 USD. Yeah, that is going to change our price of 10.16 USD.
So the drivers would be cost of goods sold, number one, and growth rate, number two?
Yeah, as first one, growth rate, WACC 2018, and as the second one, COGS.
Okay. Thank you.
And since the WACC it's a very important factor, how sensible is this discount rate to the changes of the interest rate levels and through the cost of debt of the company, and how do you build that cost of debt, the WACC? Please talk about that.
Well, actually, to first answer the last part of your question, how we built them, the cost of debt was built with the interest rate that were disclosed by the company. But as Alejandro mentioned in the presentation, the cost of debt was varied with the whole WACC because we consider the effect that the company will have because of the change in credit rating that they are expecting. They're expecting to. We believe that they're expecting to achieve an investment grade by 2019. So we reduced the premium that the company had on their cost of debt in order to reflect that. And we also consider the possible changes in risk-free rates in order to reflect also the variance in this variable.
Since it's a leveraged company and they are sensible to changes in interest rate level, are these interest rates built up in terms of basically US dollars because they have exposure to different sorts of debt?
Mainly it is built up mostly by US dollars, another portion by euros, and a small portion by Mexican pesos. But I believe that around 60 to 70% it's US dollars.
And do you think that small changes on the interest rate level would affect the valuation that you presented us for your recommendation?
Well, it actually might, but we also need to consider that the majority of this debt is issued at a fixed rate, right? So that is important also to consider.
But yeah, we did a risk analysis for the variable debt, and as you can see here in the sensitive analysis, we increased the debt by 1%, and we also decreased the debt by 1%, and we obtained these prices in our valuation. I mean, in an increase of 1% in the variable rate, our valuation is 9.14 USD per AES.
Good afternoon. Congratulations for your presentation. A question is about the price of its products. In the past years, it was a key of the strategy. Could you believe that in the future the company could increase the price as in the last years? What happened if not?
Their strategy nowadays is value before volume. Before, they used to do a lot of acquisition and merge, and that's why they end up with a huge indebtedness. But nowadays, their strategy is being value before volume, so they are expecting to keep increasing their prices. This has worked mainly for Mexico and United States. For South America, the net sales have mainly been moved by higher volumes.
Thank you much. I really don't know if this is a question or this is just a reflection with you. And I don't know if you have this information, but the shares of CEMEX has been falling, has been decreased around 28% during the last 10 years. In the same period, the índice de precios y cotizaciones, the index of the Mexican stock market, has grown around 70%, 67%. So why, as an investor, I should be buying now CEMEX when during the last 10 years this company has not given any value to the investors?
We think that the market is afraid because CEMEX in the last years has indebtedness, so they are afraid that they don't achieve the goals that they have, that is to reduce the debt and get the credit in the investment grade. So we think that the industry has potential, and also the company has potential to grow. And one of the evidence of this is that its F/EBITDA multiple is the lowest in the industry. So we think that they have potential to grow, to be in the moon, and this is an evidence.
Yes, but remember that I'm not talking about the last 2 or 3 years. I'm talking about the last 10 years. Okay. That's what you.
Just to add, you're totally certain about what you're saying. 10 years ago, in 2007, CEMEX acquired Rinker Company, which was an Australian company. And what happened is that just right after, in 2008, the financial crisis took place. So 10 years ago, it was around 2007, 2008. So that then the problem of huge investment and no sales forecasted or expected as they were, led the company to go very, very, very down. Even they reached $2 per ADS. Nowadays, by today, the stock price is around 7. So it has shown that CEMEX has put a lot of focus on the strategy to reduce those risks. And as Denise said, the industry has a lot of potential to grow, and that's why we believe that CEMEX is a good approach for buying.
Thank you for your presentation. Given the sensitivity of COGS, and especially to energy prices, and also given that the structure of futures is into backwardation, what would you do if you were an analyst, and what would you recommend to CEMEX to do in terms of how to hedge, or should they hedge energy prices given the structure of futures or in the oil and other commodities related to energy?
Yes. Right now, CEMEX cannot do like a lot of hedge in derivatives due to a credit agreement. But yeah, over there is a lot of opportunity, and also, as we can see, they're changing like to renewable resources. And right now, maybe the price is the same as the oil, but for the future, we expect that the renewable resources, like the energy, the renewable resources, will be lower than the price of the oil.
CEMEX vision is aligned to go in the future. Then in the future, the changes of renewable and sustainable energies would be, as nowadays is the same price to have a renewable energy to manage oil. Then in the future, it would be cheaper to have a sustainable company. So CEMEX would be aligned in that path to make it a most efficiency and reduce costs.
As you can see, they're expecting to use 35% up to 2020 in alternative energy sources.
Okay, but when the spot is higher than the future in prices, what is your? I'm sorry.
Thank you.
Thank you.